Welcome to the InterMarket Analysis video update. I cover a number of different topics in this video. I look at the valuation of the S&P 500 on a historical basis, as well as looking forward. I do a pretty in-depth discussion about growth versus value, because when growth is outperforming value, that's typically when we see a more positive market climate. And then we look at other markets. We look at other stocks, other indexes, and we look at the S&P 500 and see if we can get any clues as to what's happening in the market. And this is another discipline of technical analysis. This is one of many different videos that I put out each week. And this is being prepared for Monday, August 19th. I do have a thing called the SPXInvesting Program. There is a link below this video if you want to go to the website, or there's another link that will take you to more videos, a playlist on YouTube, where you can watch more videos about the program itself. Also, this is the InterMarket Analysis video. You notice this is around the outside. These around the outside are all supplemental videos. I figured that they all feed into the daily video. Now, I know a lot of people like the weekly video. Probably the InterMarket Analysis video is the least popular, but still an integral part of our analysis. A lot of people really like the what to watch video as well, but no matter what weekly video you watch, the real foundation of the analysis and commentary that I do goes into the daily videos. Now, I know people are busy and you can't watch them all the time, but this would be the most benefit based on the kind of videos that I put out there for people to watch. All right, let's go back and look at S&P 500 valuation. This is looking historically, going all the way back to 1980. We look at earnings that have already come out, and then we compare them to the current price of the S&P. And we come up with these static numbers. These are called PE ratios, price to earnings ratios. When the ratio is really low, like 10 or below, stocks are considered to be inexpensive or cheap. When we're between 11 and 19, the blue area, that is when stocks are more fairly priced. Then when we get to 20 or above, that's when stocks are considered to be expensive. Well, you look at the S&P right now, and we're way far above even the red dashed line, the PE ratio of 20. So even on a historical basis, we are considered to be expensive. But you can see going all the way back here, we can spend years above this red dashed line. So we don't necessarily use this to make decisions. I know people that practice fundamental analysis, they will look at something like this and make a decision. But we use technical analysis, but we still want to know about this. We still want this to be part of the information gathering process. Down below, I break it out. When we're above zero, I just have this chart that compares the current price of the S&P with the red dashed line. And when we're above, like we are now, that's also showing that we are expensive on a historical basis. This is the same chart, but also plotted in here are different events that have happened going back to 1980 and what the valuations were at that time. Again, this is more for information. Then Robert Shiller came out with a slight twist on the PE ratio, where he came up with a more smooth effect. This looks at price and earnings, especially earnings over a period of time, to try to get rid of outliers, just great quarters, great years, and then smooth that out over a period of time as well. And this is called the Shiller PE ratio, or you might also know it as CAPE, C-A-P-E, or I've also seen it as PE 10, because he usually looks at earnings over a 10-year period of time. And then he comes up with a current value. Well, the current value is at 35.82. To give us some context, we can look at a couple of different things. We can look back and all the way into the 1870s here and see what was the PE, the Shiller PE ratio at that time. And then we can also look at the median and the mean. And we're just a little under 16 with the median, a little over 17 with the mean. So when you look at this historically, this is still suggesting that stocks are expensive this way as well. Now, you can do some other studies in here and compare it to more recent times and so forth, and probably justify the price being this high. I tend to look at this as a big picture type of analysis. Okay, this is a chart that I ran across throughout the week. I don't usually include this in the video, but this is valuations against allocations. where we see more than ever before U.S. households holding equities, a percent of total financial assets. And after somebody's home, the next thing down as far as wealth is this blue line here, which are equities, and that means stocks. Well, we can compare that to the CAPE, the Shiller PE ratio, which is also going up here, and we also can compare that to the 3-month T-bill rate. So this just gives us an idea where we are possibly at the point where the Fed's going to come in and start cutting rates. So this may start going down, at least if we maintain the more positive context. Now, we were in this positive context before where they thought, okay, the Fed's going to come in September, they're going to cut rates, and it's to stimulate the economy, but the economy's still doing okay. That's what the stock market has been riding for most of 2024 and even going back into 2023. Well, then we had the employment situation report come out early in August, and it was much weaker than expected. And that fed over into, oh my gosh, we're looking a little too weak here. In fact, we might go into a recession. And then after that was when things fell apart in Japan, and we saw the really big downward move in the early part of August. We've since been able to recover from that. But now the reason why we're recovering is the market is shifting back to this idea that we're not necessarily going to go into a recession. The economy is not falling apart right now. And so the Fed can still come in and lower interest rates, and it's more to help the economy rather than reacting to things falling apart in the economy. And so this may be coming down, and if we maintain this current scenario, we might still continue to see both of these go up as price goes up and people want to own more financial assets, specifically equities or stocks. Okay, but the market doesn't do that. The market looks forward when it comes to earnings, not just historical. We can get some context from that, and that's still helpful. But analysts have forecasts and projections, and they come up with what they think earnings are going to be well off into the future. And then that is also priced in to the current value of the S&P 500, and it's represented here on this chart. Well, you've probably heard of the Magnificent Seven or Great Eight or whatever you want to call them. On this chart put out by Edward Yardeni, this is the Mega Cap 8, and this is the forward PE ratio. And it had gone well above 30, and it was getting a little bit pricey there. Now, since we saw the pullback, it's been coming back down. We're still getting a high reading. We use that 10, 15, 20 scale also looking forward. So this is still rather expensive. That's the purple line that you see here. But people want to own NVIDIA. They want to own Apple and Google and all these high-flying companies. And so they're willing to pay for future earnings that they hope will happen. And that's why they're expensive, but people are still willing to buy it anyway. And it's coming in at 27.3. Now, to give it a little more context, we look at the red line, which is the S&P 500. We also use that 10, 15, 20 scale. As of Friday's close, we're back above 20 again. We're coming in at 20.9, and that's even looking forward. That's even with earnings looking positive going out into the future. So this is getting back to a little bit expensive again here, but we can stay up here. We actually got above 22 here back in 2020, so this can still go higher. We don't use this as a timing mechanism. This is more for information. Now, when we drop down and look at the blue and the green line, these are the mid caps and the small caps. The green line are the small caps, and they've been seeing a little bit of favor here, but their earnings just aren't quite there yet. And that's why we haven't seen their price going up. So when you combine the two together, we're just under 15 at 14.9. So we're actually a little bit on the inexpensive side there, because small caps, they have to borrow a lot of money. And with interest rates higher, that bites into their earnings. Well, if interest rates are going to go down, that could really help small caps, because now instead of that money going to pay interest, that money could be going to earnings, which justifies their stock price going up. Well, also not too far from that is the blue line. These are the mid caps, which earlier in the year, this was one of the stronger indexes. Now it's one of the weaker indexes, but it's coming in at 15.4. Now, what I focus on the most is the red line, the S&P 500. And yeah, it's a little bit concerning to have this above 20, but it's been above 20 before, and the market has still performed well. It's also been above 20, and the market has gone down. So We just want to keep an eye on this and use it for information. Then I do a pretty extensive discussion here about growth versus value. Growth is when you want to buy low and sell high. Buy a stock at 10, sell it at 20 at some point in the future. Value are stocks that tend to hold up better when the market is getting defensive or looking at declining. And so we want to constantly be looking at the relationship between these two. Now, the first thing we look at is just growth all by itself. And this had really been pulling back, and this is when we were seeing some problems in the market from July going into the early part of August. We finally bottomed on that big down day. And since we've been bouncing back up, we've been able to get back above the 50-day moving average when we look at this index all by itself. Then we look at value all by itself, also in an uptrend. The blue line's above the red line. It was doing better. It came all the way down to the 200-day moving average when we saw the big decline on August 5th. It has also been bouncing back. So when you look at these independently of each other, they're both doing pretty good. It's when we do ratios between the two, that's where we get some additional insight. And on top, I have a growth to value ratio here, where growth had been coming down to the 200-day moving average and now bouncing back up. So it's improving, and it's still in a longer-term uptrend. Then, just to get a little bit different perspective, and because there's different calculations that take place, here's an inverse of that same chart where we look at value to growth. Where value has been underperforming, it came all the way back up almost to the 200-day moving average. You notice we hit the 200-day moving average with this ratio, and we were a little bit short on this one. That's why we like to look at inverse charts sometimes. But now value is starting to come back down as growth has been over the last couple of weeks since we saw that big decline on August 5th. Growth has been more in favor, but value's still been doing okay on its own as well. Then we look at some ETFs and do a ratio between growth and value, where we saw growth really breaking out, almost getting a little too far away here, and then it came all the way down to the 200-day moving average and then bounced back up. Then this is an inverse of that same chart, showing how value had been underperforming, almost got up to the 200-day moving average, and has since been coming back down. And then we look at these indexes that I had been looking at before, but this is a longer-term chart. And it's been really choppy in 2024, but for right now, growth is still continuing to outperform value. We still are in an uptrend with the blue line above the red line, even though we did drop down earlier in August. And then this is another look at that same chart, but not as long of a time frame here. This is showing how value is underperforming growth, even though it bounced back up. Now it's been coming back down. So we're seeing some confirmation, whether we're looking at an index or ETFs, and I also have a couple of additional studies to show here in a moment. This is another look showing how growth has been outperforming. It really was doing well, then it pulled back. Now it's starting to show some improvement. And if we're to be positive on the market, we want growth to outperform value. Then here's a couple of ETFs. And I've been talking about this in the daily videos each day, where we saw growth really outperforming value between these two ETFs, and then it came all the way down, actually dropped below the 250-period moving average, but since then has been really recovering. We're still inside the rainbow. We want this to continue to go up if we're more positive on the market. Now, we break this down a little bit more, look at small caps and do a growth to value ratio there. It's bouncing up a little bit here, but not showing any real strength. Also, we've just seen a recent death cross with this ratio. So this is a little bit concerning to us for the small caps. Also, we're seeing a downtrend here with the mid caps, where it had been stronger. You look at December and January into the early part of March, growth was the strongest index, and growth was really, mid caps were the strongest index, and growth was really leading that higher. Well, this is kind of fallen on hard times, even though lately it's been bouncing back up. This is the one that I probably pay attention to the most, and it's looking okay, but not great. We look at S&P growth to value and do a ratio here. The blue line's above the red line, so longer term, we're still in an uptrend. We were starting to bounce back up, even though we pulled back on Friday. To be even more positive, we want to see this ratio continue to go up and actually get to the point where it surpasses this previous high that was set earlier in the year, back in July. And then this shows value against growth. This is just an inverse of what we were looking at, how value had been underperforming. It was starting to bounce back up. Now it's starting to pull back. Then we also want to keep an eye on inflation. This is a monthly chart, so it takes a long time for these things to really change. This is very, very long term. We look at a monthly chart of the CRB index, which are commodities, and we're still above the moving average here. So longer term, they're in an uptrend. And then we do a ratio between inflationary areas and deflationary areas within the CRB index. When this is going down, that just generally means inflation is not a problem. We don't want to watch this because if this really starts to tank big time, deflation is also a problem if it gets to be too overblown. I know that sounds like it might be a cool thing that prices are going down, but it does a lot more damage, hence the Great Depression that we saw. So, but right now it's not really giving us any major warning signs. Then here's a daily chart of the CRB index. Here's a breakdown of the percentages within the index itself. It had really been falling back. And this is when, oh my gosh, the economy's falling apart. Oh my gosh, we're going to go into a recession. Well, since things are turning back a little more positive, we've been seeing this bouncing back up, and it's still in a longer term uptrend. Then we look at the Baltic Dry Index. This is to ship things, specifically in the Baltics. Now, as a general rule, when this is going up, it's more inflationary. When this is going down, that's more deflationary. We've been really chopping around. Actually, it's been dropping down a bit lately. So this is not showing that inflation is a problem by looking at this gauge itself. And we look at some other markets. I'm not active in any of these markets, but we still want to look at them nonetheless. This is aluminum, which is in an uptrend, but has really been pulling back. Corn. I just had some corn today, corn on the cob. It's that time of year. This is in a downtrend. So if it keeps going down, next week I can have corn again and pay even less money. All right, then we have wheat, also in a downtrend. So as far as food is concerned, we're not seeing really any inflationary pressures when we look at the products that are grown on farms. Fertilizer also not really breaking out. It's pretty much been going sideways throughout the summer months, not really putting a pressure on prices. And then oil, of course, this is something that we're watching for a couple of different reasons. One, because it's inflationary if it goes up. Also, if it goes up for geopolitical reasons, because things may escalate in the Middle East, that could cause some problems. Now, oil can go up and actually help the market go up. You can see here where it was really going up into 2007, the stock market was doing really well at that time. Well, then we had the great financial crisis where everything came crashing down. Well, if this goes up because the oil companies are making more money and they have nice profits and they look attractive to buy their stocks, then yeah, oil can go up and stocks can go up at the same time. But if this goes up because of political unrest around the world, then that's negative because something bad is happening. And if this spikes up for that reason, then that typically will pressure stocks. Heating oil, well, we don't have to worry about that too much, at least in the northern hemisphere during the summer. And this has been in a downtrend. Gas, which has also been coming down. You notice, we have a presidential election coming up here, and gas is what people feel the most. They can see the prices going up and down, and if gas prices are going up, whoever's in office right now, they want to get them out of there. So what do those people in office do? They do things to make gas prices go down. All right, natural gas also going down right now, and still it's still in an uptrend. The blue line's still above the red line. And I know this is kind of hard to see, but it's really been falling back lately. We also keep an eye on diesel. This is mainly for 18-wheelers and railroads. And this is the spot price. Now, a lot of the charts we've been looking at are futures prices. This is what they think prices will be going out into the future. That's why they're called futures. Where the spot price is, what is the price right now? And diesel has been coming down. And that actually helps things as far as transportation costs. Copper, which is a barometer of the economy, when this is going up, then this market is anticipating economic strength. Well, we've been seeing copper really coming back down. It's still in an uptrend because it takes a while for these moving averages to cross each other. But this is about the time when people were starting to freak out about the economy. And we saw copper really starting to underperform. It's since been trying to bounce back up, but it hasn't been able to clear its 200-day moving average yet. Now, another thing, copper tries to look at what's the economy doing. Gold, they say, is a hedge against insanity or inflation. Well, we don't know what's going to happen now, and the market's a little bit confused. So lately, as copper's been going down and gold's been going up, that's why we're seeing this ratio going down right now. We took a longer term look at that same relationship going all the way back to 1980. That's the black line where we're seeing copper really underperforming. To give it a little more context, we look at the 2-year yield in green and the 10-year yield in red, and these are coming down as well. But we're also continuing to see the copper to gold ratio going down as well. And then here's the gold ETF. I don't follow the futures contract. This is the ETF, which is a derivative of gold prices. And it broke out and is now setting a new all-time high. And you have people that have been touting gold as the greatest thing to ever have, going back 20, 25 years or so, actually longer than that. And they just kept saying this over and over and over. You look at the Elliott Wave folks, and they always had an upline for gold and a downline for stocks. Well, for the last 20 years, it's been the opposite of that. Well, now they're finally enjoying the party because gold is starting to break out. Now, one of the benefits of gold is that it's an actual physical asset that thousands of years ago, it was worth something. And if we're still here thousands of years from now, we haven't destroyed ourselves, it'll probably be worth something then as well. So that's one of the benefits. But this is not physical gold here. This is an ETF, which represents the price of gold. We also keep an eye on silver, lagging behind a little bit here, still under its 50-day moving average, not breaking out to a new all-time high. Then we look at the closing price for gold on top, which has been breaking out. And silver's been doing well, but it's not back at an all-time high yet. But the correlation between the two is fairly strong. When the higher this reading is, that means that gold and silver on a closing basis are going in the same direction at the same time. Now, this chart's really not helping us. We have a gold to silver ratio on top. When this is going up, gold is outperforming silver. When this is going down, that means silver is outperforming gold. And then we look at the correlation on the bottom, and we see they're actually going in opposite directions. In the middle, we look at the US dollar index. And copper or gold has been really outperforming, but the dollar's been under weakness. And so that's why we're seeing this correlation really trailing off. That's what I was trying to say. And going in opposite directions right now. The US dollar index daily chart. Now, if you watch the weekly video, I show a weekly version of this same chart. We're giving a death cross with the trend on the weekly chart. We have been declining here on the daily chart, but we haven't crossed below the moving average yet to get another death cross here. And then we look at a further out measurement of the US dollar index going back 3 years. I drew a line from this top, and then I went down and connected this other high that we had here. And then I tried to, it just worked out where this other top lined up, and I just extended the line down just to give it a little bit of context. I'm not a big believer in diagonal trend lines. Yeah, I use them, but I think a horizontal line is more powerful than a slanted line. And because people can get very liberal with the trend lines that they draw. There are rules for drawing these trend lines, and a lot of people don't follow them. And as I always say over and over, you draw enough lines on a chart, you can get it to say whatever you want. There's a chart that I use in my classes where somebody is picking out what's called a head and shoulders top. That's usually very negative. Well, some people look at that exact same chart and conclude there's a head and shoulders bottom. And it's the same exact chart. See, what I try to do with my analysis, I'm not trying to subjectively put my opinions into what I see happening. I try to use charts and analysis that just says, okay, this is going down here. You can't really read that any other way. After here, it had been going up. Can't really read that any other way. All right, then we look at the euro, which has been chopping more or less sideways. It's pretty much a mirror image of the US dollar index because so much of the euro is connected to the US dollar index. And then we look at the Japanese yen. This was the cause for a lot of the problem on Monday, August 5th, when we had the big decline, because the yen has just really been in a free fall against the dollar. Well, it started to go back up, and that was freaking out a lot of people in Japan. We were already seeing weakness here in the US because of the economic reports that were coming out. And then everything just kind of converged together, and we had that big down day on August 5th. And even though we're going up here with the euro, we're not in an uptrend against the dollar yet. And then down at the bottom, to give it a little more context, is the US dollar index. Now I have a breakout. This is the euro to the dollar, and it's been going up, but the blue line has not crossed back above the red line yet. It's still just a little bit below. So this technically is not an uptrend yet. The Japanese yen, which was really going down compared to the US dollar, this is when the Japanese government started to step in. They started raising interest rates. When you raise interest rates, the currency in that country, it becomes more precious, just like Gollum would say, because it costs more to borrow that particular currency. So they raised interest rates and the yen just started to skyrocket up. And that's what was freaking everybody out. That's what you call the carry trade, because the yen was going down. They had been at zero interest rates for years in Japan. And so people were borrowing money at a low interest rate and then making that money go to work by bringing in a higher yield or a higher return on that. Well, as the yen started to go back up, that threw everything into chaos. And that's why we saw that real decline in Japan that pretty much went around the whole globe. The dollar compared to the British pound. The British pound is still outperforming. We have the blue line above the red line. Some index ratios here, and I do show this in the daily video. As a general rule, even though they're on different scales, you see when the red line is above the S&P 500, this is an equal weight version of the S&P. That means the market is doing better on a broader scale, because the S&P 500 is a weighted index. And so when the Magnificent Seven or Grade 8 or Illustrious 11, whatever you want to come up with, when they're outperforming, that's really driving the indexes higher. But when this red line is going up even more than the S&P itself, that means the rest of the stocks in the S&P 500 are actually holding up well. And that's what we've been seeing lately here. Here's another way of looking at that same thing. When this is going down, that means the equal weight stocks are underperforming. Well, this has been bouncing back up as we were starting to shift over into that negative scenario. Well, now we've been going back up. That's what caused this bounce here. But now that we're shifting back more to the positive scenario, we're continuing to see this ratio going back down. And we look at stocks to commodities, showing how stocks are outperforming commodities. And here's an inverse showing how commodities continue to underperform stocks. We look at the NASDAQ 100, which has been doing better. It's still not performing as well as the NASDAQ, but it's having a really good year and it's showing some improvement. And the S&P 500, which is also having a good year. Well, for much of 2024, when we got into the spring months, the NASDAQ 100 was outperforming the S&P. Then we started to run into some problems in June and into July, and then it kind of bottomed out, at least it looks like, in the early part of August. Now we're starting to see the NASDAQ 100 coming back more with a vengeance. Now they're both doing good, but to really lead things higher, we need to see the NASDAQ 100 go back to outperforming the S&P. This is the S&P 100, which are the biggest stocks in the S&P 500. They had been really outperforming, falling back, now showing some improvement, even though we've seen a death cross with this ratio. The NASDAQ to the S&P, both have been doing better. And actually, the NASDAQ is doing better than the NASDAQ 100. And I'll show you that. Where the NASDAQ has been outperforming, it's in a longer-term uptrend. It pulled back because the NASDAQ is mostly tech. The S&P 500 has tech, but it also has a lot of value, some more defensive stocks. So when we're going down, the S&P 500 tends to hold up better. And so that's why we saw this ratio coming down. Now we're starting to see the NASDAQ improve. And we look at here's the NASDAQ 100 to the NASDAQ itself. For a lot of 2023 and even into the early part of 2024, the NASDAQ 100 was really outperforming. Well, we've seen this drift lower. We're actually seeing a recent death cross in April where the NASDAQ 100 started to underperform the NASDAQ itself. And this past week, the NASDAQ performed better than the NASDAQ 100. But it's starting to go back up here. If this can continue to go up, that means the bigger stocks, the real heavy-duty tech stocks, they're really doing well. And that also helps the indexes, the NASDAQ 100 and the S&P 500 to go higher also. We look at the mega cap. These are the monster big companies and compare them with the S&P 500 equal weight, where the mega caps are outperforming, fell back, came almost down to the 200-day moving average, but have now been showing an improvement. Small caps, which were showing some love here, they were starting to outperform the S&P, even though longer term they were not. Now we're seeing this coming back down as the bigger stocks are outperforming the small caps. And here's another look at that. The red line that you see here is a ratio between small caps to the S&P. When this is going down, that means small caps are underperforming. And then to give it a little more context, in blue here is the S&P 500. We look at the biggest software companies, not really breaking out, not busting out to the upside, not really breaking to the downside, pretty much going sideways, but still in an uptrend. We look at mega cap all by itself, an ETF, where we had fallen down below the 50-day moving average. Well, we were able to get back and close above that by Friday, and we're still in a really solid uptrend here. Robotics and AI ETF coming down, fell below the rainbow, starting to show an improvement. But when we look at a ratio between the robotics and AI ETF and compare it with the tech sector, it's now back to starting to underperform. The Dow Jones Composite Average, which takes the Dow, the transports, and the utilities, puts them together into one composite average. And a lot of this throughout at least the last few months has been the utilities really driving things up. Now the Dow's showing some improvement, but transports have been a real disappointment. Then we look at the S&P 500 and look at short-term bonds, 1 to 3 years. This had been really falling down as they were worried about the market falling up or the economy falling apart. Now we're seeing it come back up and start to go outside of the rainbow. This is the S&P 1500, which is a broad market measure. Also looking at that compared to shorter-term bonds, starting to come back up out of the rainbow again. So it's not just the S&P 500. We're seeing this across the broad market as well. Here's another broad market measure looking at further out bonds, also starting to come up to the top end of the rainbow. This is a daily chart of the Wilshire. And I was really watching this because this is another broad market measure that we look at. We had fallen below the 50-day moving average after it had been providing pretty good support. We never got down to the 200, and then this was the big down day. Well, it turned more positive when we were able to get back above and close above the 50-day moving average. This is the biggest ETF that I can find that has the most number of stocks in it. This also fell as everything else was falling, but now we've been able to get back above the 50-day moving average. And then we look at low volatility stocks, which are more defensive. These are stocks that tend to hold up better when the market's going down. It doesn't mean they go up, they decline, but they probably decline less than some of the big name companies. Well, since going back to the beginning of 2023, the low volatility stocks have really been outperforming. Then there was this fear that the economy was falling apart, so we saw this spike up. Now it's starting to come back down as we're going back again, at least for right now, to that original scenario. Low volatility stocks all by themselves, they are looking good. When you look at this, they're above their 50-day moving average, and they've been in a solid uptrend going back to the late 2023. Then we look at the tech sector and compare it with 3 to 7 year bonds, had been falling back, now starting to show some improvement. And we look at other stocks here. This is the advanced decline line studies. I also show this in every daily video. And we're looking good across the board with the NYSE common stock, the S&P, the mid caps, and the small caps. They're all above their moving average. And that's the line in the sand for me. When they're above the moving average, that's positive. When we drop below it, that is negative. We look at Dow theory. Now, this is traditional Dow theory, where traditional Dow theory just looks at the Dow and the transports. We've been seeing some bouncing coming back with the Dow. We are improving with the transports, but we've been just chopping sideways here for a long time. The utilities were really coming on strong. They pulled back, and now they're more or less going sideways. Here's the transports all by themselves. They were in a higher range in the earlier part of 2024. Then we dropped down to a lower range. Now we're kind of right in between the two ranges. We also do a ratio between the transports and the S&P. When this is going down, that means the transports are underperforming. They started to show a little nice bounce here, but now they've been starting to show more weakness as they underperform. We look at a correlation between the S&P and the transports, and they're still pretty strong, which means if one's going up, the other one's going up, and if one's going down, the other's going down. So this is a pretty strong correlated relationship, even though the transports have been underperforming. We look at another ratio between the Dow and the transports. When this is going up, that means the Dow is outperforming. But for the last couple of months, we've been pretty much chopping sideways with this ratio. So no one is really leading. And it's really the transports that are underperforming. This is a new way of looking at Dow theory, where instead of using the Dow, we use the S&P 500. Maybe that's a better representation of Dow theory. And instead of using the transports on the bottom, we look at the NASDAQ because we're more of a technology-based economy now. And then we just kind of compare the two, and they're both showing some improvement, but not reaching their previous all-time highs, at least yet. Then we break that down a little bit more. Instead of using the S&P, why don't we use the S&P equal weight, where it's been showing a nice little bounce here. And instead of using the NASDAQ, let's use an equal weight version of the NASDAQ 100. This has also been improving, but it is lagging a little bit behind. It has further to go to get back to the all-time high. The FANG index, these are the big monster companies: Facebook, Apple, Amazon, Netflix, Google, NVIDIA. They've even changed the acronym, but I just stick with the same one. This is one thing that I was watching. When we were really declining on August 5th, we came right down to the 200-day moving average, and we were able to bounce up off that. Now, this is not the only thing that we saw. We were setting up intraday support in the S&P, and there were some other indexes that were also hitting support, and that helped us to be able to bounce up out of that. Another encouraging thing is here, even though we're in a longer term uptrend, we're just a little bit above the 50-day moving average. We want to see this continue to go up, and this will help the NASDAQ 100 and the bigger weighted parts of the S&P 500. Here's another chart where I drew some trend lines here, where I had going from this low to this low and then just shooting it forward. We actually fell down below that when we saw the decline. Well, we were able to get back above that. Then I have a shorter term trend line going from this low to this low, and we've been able to get back above this. So we're recapturing some of these support levels that we had lost, and that's encouraging. ARC, well, not doing so well. It's in a downtrend, both on here on the daily chart and on the weekly chart. It had a pretty good week, but it's just coming right back up to its 50-day moving average and still in a downtrend. And then we look at all world stocks, but we take out US stocks. And this also got hit and is now coming back above its 50-day moving average. Then we do a ratio between US stocks and the rest of the world stocks. And this is really busy up here, but we're starting to come back to the 50-day moving average, meaning that US stocks are outperforming the rest of the world stocks. And here's a longer term look with a monthly chart. We take a ratio of the S&P 500 to also looking at global stocks in Europe, Australia, Asia, and the Far East. When this is going up, that means the S&P 500 is outperforming. Now, this is a monthly chart, so this is very long term. And even when we look down below with the PPO, which is a momentum oscillator, this continues to go up. Look at bonds based on price. Really seeing some improvement here and in an uptrend with the total bond ETF. There's a world bond index, and even though we're going up, we have not seen the blue line cross above the red line yet. So technically, this is still in a downtrend, even though it's showing a lot of improvement. And then this is a look, and I do this in different time frames. I go over a weekly version of this chart in the weekly video. This is a daily chart where we were starting to get some concern here where bonds were coming up to the moving average here. Well, since then, they've been pulling back. There's a monthly chart where we look at a stock to bond ratio. This is very long term. A week ago, we were coming all the way down to this moving average. Now, this is a monthly chart, so it's not going to complete until the end of August, but this is showing some improvement now. We'll look at high yield corporate bonds. You also know these as junk bonds, and they are going out and setting new all-time highs. Then we look at investment grade bonds. These are more conservative, also looking pretty good, but still have a ways to go to get back to their all-time highs. Now, this was in 2020. This is when interest rates were at zero, and these corporations were getting all kinds of benefits and incentives and money and all these things. And so it was really helping this ETF to go up. So this is one of these anomaly type things that have happened. So we just look at this by itself where we are in an uptrend with corporate bonds. And then we look at a ratio between riskier bonds, which we also call junk bonds, and more conservative bonds, which would be government bonds and maybe more established corporations. we were seeing kind of a little bit of a concern here as we were dropping down. Folks were getting out of the junk bonds, starting to get into the more conservative bonds because they thought, well, maybe if we're going into a recession and that's why the Fed's going to cut interest rates, we better get out of these junk bonds and get into government bonds. They're safer and we can lock in a maturity for a longer period of time and virtually not take any risk. Well, that's when we were falling down. Now we're starting to see this come back up as maybe the economy is doing better. And so now folks are trying to drift back over into junk bonds because they're willing to assume that risk to get a higher yield. And we look at a correlation between stocks and bonds. They're having a slight tendency. Now, these are stocks and bonds based on price. They're tending to go in the same general direction right now. We look at the Dow Jones Corporate Bond Index, also breaking out and looking pretty solid right now. Here is the 10-year yield with some Fibonacci retracement lines. We're far away, so I haven't extended these over, and there's really not much to pull from this. This is a 40-year look at the 10-year Treasury yield, where we were seeing for 40 years a series of lower highs and lower lows as interest rates kept going down, 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 down. Then we had the whole COVID lockdown. Now we're starting to bounce back up. And what we're seeing now is actually a shift to a higher interest rate environment, which is actually the norm. This 40-year process, that's not the norm. This was the exception. And so we may be going back to a higher interest rate environment here, but we have been coming down with interest rates lately. And we look at a ratio between the S&P 500 or stocks and the 10-year yield. And this is showing that stocks, as represented by the S&P, are outperforming. Then we have another 30-year Fibonacci chart here, not really close to any of these retracement levels. And then we look at a ratio between 3 to 7-year bonds and stocks. When we were starting to fall off a cliff, this was really going up. Now it's starting to come back down. If this continues to go back down, that is more positive for stocks. That means bonds are underperforming stocks. The junk bond ETF is still holding up well above its 50-day moving average and doing quite well these days. We look at a 7 to 10-year Treasury bond ETF. This is based on price, where we've been chopping sideways now, but this is still holding up in an uptrend well above its moving averages as bond prices have been going up and interest rates have been coming down. And we look at a ratio between junk bonds and government bonds. We started to see this change. We're dropping below here with this ratio, but now we're starting to go back up as maybe the economy's still doing okay. Here's a daily chart of yields across the whole maturity cycle, or the whole, I don't know what to say here. They go from 3-month up to 30 years. And overall, they are declining, but we see a lot of bumping along the way. What was I trying to say there? The whole scope of the maturity scale. This is a weekly chart looking internationally. We still have US and German rates, UK rates the highest. In blue are the German rates, and Japanese rates are actually coming down. That's been helping the Japanese market because raising interest rates is what caused a lot of that problem that we saw on August 5th. And then we look at the MOVE index, which measures the volatility of bonds, and that's been coming down. And then the VIX, which spiked up over 60, it's really been coming down. It's actually under 15 now. But we see that there's still a pretty strong correlated relationship. Now, this is not measuring bonds based on price or stocks based on price. This is measuring volatility to volatility, and they're both having a pretty strong correlated relationship based on volatility. Here's a monthly chart of the long-term bond ETF, where we're finally, after a long period of time, we had been just declining, going back to 2020, the end of 2020. We're coming back above the moving average now. That means longer-term bond prices are starting to go up. And then we look at a ratio between bonds and the commodities. Even though bonds have been under pressure, they still have been outperforming commodities longer term. Then we look at different sectors, and I say this every time. I just go through these sectors alphabetical based on their symbol, and B comes first here. So we look at the materials sector. It's in an uptrend by itself. Then down below, we look at the relative strength ratio compared to the SPY. That's the ETF for the S&P. Some of these are also compared to the SPX, which is the S&P 500 index. And we're also going down here on a relative strength momentum basis with the green line. So this is showing a little bit of weakness, but we're still above the 50-day moving average. Now, this is looking at it all by itself. We get some more insight when we do a ratio between materials and the S&P 500. We were starting to see materials show some strength, but now it's starting to pull back and underperform the S&P. Communication, a stronger area, has been. Some of the big companies that people love are in this particular sector. We were able to get back above the 50-day moving average, even though we're rolling over a bit with momentum and relative strength. And we're pretty much going sideways because the S&P's been doing good in 2024 and communication has been doing good. So we're not really seeing any outperforming the either right now, outperforming the other right now. Energy is still above its 50-day moving average, but starting to decline with relative strength and momentum. Then we look at energy, which is still underperforming the S&P 500 here and in a downtrend. The financials, which are really doing well, and for the economy to do well, for the stock market to do well, we want the financial sector to do well, and it's doing well all by itself. And it's still holding up. Now, the S&P's been doing well in financials, even though they're in a downtrend here, they have been bouncing back up lately and showing some real improvement. Industrials also in an uptrend above their 50-day moving average, but showing a little bit of weakness with relative strength and momentum. But when we compare it to the S&P, really underperforming, started to bounce back, now back to going down with this ratio. Tech sector, there's a real darling. Now this is all by itself. It was under a lot of pressure. We actually dropped below the 200-day moving average. We've been able to come back up to the 50-day moving average. We want this to really continue to go up if we're going to be more positive. Tech is a huge part of the NASDAQ 100 and the S&P 500 on a weighted basis. And we're going up with momentum and relative strength after getting very negative there for a while. We look at a ratio. Also, both the S&P and tech sector have been doing well. We saw some weakness when tech was going down. But overall, this is pretty much chopping sideways currently. We look at staples, and you look at them all by themselves. This is toilet paper and toothpaste. This is what people get into. And look how they're breaking out now when you look at them all alone. And they're well above their 50-day moving average, although they're rolling over a bit on a relative strength and momentum basis when compared to the S&P 500. But if you look at this chart and you go, yeah, I want to get into this. But if you compare it to the S&P, it continues to underperform. Now, as economic fears were coming in, we saw staples really start to outperform, but now they've been pulling back. And we look at real estate, which is going up all by itself and above its 50-day moving average. It likes a lower interest rate environment because that means mortgage rates and costs and all the things that get into real estate tend to be more attractive when interest rates are going down. But we're seeing a little bit of a rollover here with momentum and a relative strength. But when we look at it compared to the S&P, really underperforming, starting to bounce back, now starting to come back down. Utilities. And again, there's a couple of different ways you can view this. It's been breaking out and it's near its all-time high. And that's usually a defensive play. And that's when the market's getting ready to have more of a decline. Another way to look at this is, okay, with all these EVs and AI and Bitcoin mining, there's a lot of electricity that is needed. And so they see a real demand for that, and that helps this sector to go up. But when we compare it to the S&P 500, it's still in an overall downtrend here, but it has been bouncing back up, but since then has been pulling back. But we're keeping an eye on this one. And then we look at a ratio, and I look at this every day and show it in the daily videos. When this is going up, that means the S&P is outperforming utilities. When this is going down, that means utilities are outperforming the S&P. We had been really declining, but now we're starting to bounce back up. And we look at healthcare, which is another defensive area since you have to have it no matter what's going on in the economy. Looking pretty good all by itself, well above its 50-day moving average. Well, it had been performing better when compared to the S&P, but now it's starting to go back to underperforming. And discretionary, the thing that makes life fun, this really got hit hard. And this has been a real disappointing area. Tesla's in here. And so we're coming back, but we were able to get back above the 50-day moving average. But when we compare it to the S&P, this continues to underperform. And we really didn't see all that big of a bounce here back in June and into July. We want to see this doing better because this is kind of a pseudo growth versus value area. Semiconductors, a massive part of the tech sector, came all the way down, dropped below their 200-day moving average. They've been clawing their way back, but have not been able to get back above their 50-day moving average. We look at a ratio between energy and tech, showing how energy is underperforming. When things were turning more negative, energy started to outperform, but now it's been pulling back here. We look at growth stocks and compare them with bonds based on price. When we were running into trouble, this ratio was going down. Now it's starting to go back up, and it's still in a longer-term uptrend, meaning that growth is outperforming the price of bonds. We look at the tech sector and compare it to the 10-year yield. This still continues to show that the tech sector is outperforming. Here's an inverse of that same chart showing how the 10-year yield is underperforming the tech sector. We look at a ratio between discretionary, the fun things, versus staples like toilet paper and toothpaste. We were really starting to show an improvement here, but then we really fell back. We are starting to bounce back up, but we still have a lot of damage that needs to be repaired with this ratio. There's an inverse of that same thing showing how staples were beginning to outperform, falling back, but they're still in an uptrend when compared to discretionary. We look at a gold to S&P 500 ratio, not really showing all that much of a breakout. You wouldn't know that by all the people that tout gold. And like I said, gold is not bad in and of itself. It's when it becomes a religion. That's when I start to kind of, okay, I don't know if I want to take it that far. Because the S&P has been doing well also, even though gold has been breaking out lately. And now this is where we're seeing a little bit of a difference. The dollar's been going down, gold's been going up. That's why we're seeing this ratio going up. And high leverage loans, they got hit when everything went down August 5th, bounced back, and now we're well above their 50-day moving average. These are very risky loans, and I take that there are very smart people that get into this ETF. They're really concerned with what's going on with the economy. And if the economy was falling apart, which it looked like they might be giving into that, well, it's not necessarily looking that way now. The NYC Composite was able to get back above its 50-day moving average and is in an uptrend. All stocks are back above their 50-day moving average, looking more positive. Emerging markets, still in an uptrend. They got hit with everything else, starting to bounce back up now. And the Nikkei, Japanese Nikkei, it fell that 12% in one day. We're almost back to where we were before this whole mess started. Microcaps, the really small companies, came down, hit their 200-day moving average, starting to go back above their 50-day moving average. Now, this is one that I did talk about in the daily video for Monday. We're seeing a divergence here. We're not sure if it's positive or negative. The S&P has been going up, but it's been going up a lot more than the home builders ETF. And so we're seeing a real drop off in the correlation between the two. We get down here and I mark this yellow. We don't know. Is this a good thing? Is this going to drag the S&P down? Or is the S&P going up going to bring the home builders up to try to restore this strong correlated relationship that they've had for a long time? Bitcoin starting to see a death cross here, dropping back down below, what is this, 59,000? It's right around the 60 level, high 59s now. This is a long-term chart using a KST, which is a slower oscillator. We're starting to turn back up in China. The emerging markets are turning back up, starting to turn up in Europe. Japan, looks like it's trying to turn up, and we're trying to turn back up in the US. So globally, we're seeing an improvement. InterMarket Analysis, the name of this video. Going back to the beginning of 2024, we have gold in the lead. The black line, those are stocks. The red line is oil. The green line is the dollar. And we had finally gone positive with bonds based on price, only to drop down negative. Now we're back to being positive on the year. Some correlations. We look at the S&P 500, that's black, compared to the US dollar index. This is really dropping off, and when it's below the blue line and above the red line, I consider this to be neutral. They're not really going in the same direction or opposite directions, because you can see the S&P has been going up, the dollar's been floundering a little bit down. We also look at the correlation between the S&P 500 and oil, still having a fairly strong tendency to go in opposite directions. Now, if oil spikes because of geopolitical events, especially in the Middle East, And that's going to make stocks go down and oil go up. And we're going to see this relationship really drop down and actually go in opposite directions. But we don't know if that's even going to happen. We're kind of hoping it won't happen. And then we're looking at the S&P 500 to the 10-year yield. They're also in neutral territory. We look at the tech sector to the 10-year yield, also in neutral territory. We look at the S&P to the 2-year yield, having a slight tendency to go in the same direction. Then some long-term studies here. This is a monthly chart of the NYSE composite, a broad market measure. We're above an advancing moving average. That's positive. And we look at a momentum oscillator. That's the Kopic curve, and it's continuing to go up. And this is a daily chart, and we look at a thing called the NYSE record high percent index. This is also starting to go back up after it had been seeing some weakness. Then here's a monthly chart of the S&P above its longer-term moving average, and the momentum was rolling over a little bit, but as we're bouncing back up, this is starting to show some improvement. And then we look at a daily chart of the S&P on top, and then a ratio of stocks to commodities down below, showing that stocks continue to outperform commodities here. And then here's another chart, a monthly chart of the NYSE above the moving average. Longer term, the momentum oscillator is represented by the Kopic curve, is also still going up. And we look at one more. It's a ratio between the S&P 500 and global stocks on a monthly basis, showing how U.S. stocks continue to outperform. The KST is still pretty much flat right now. Since this is a monthly chart, it takes longer for this to develop into something. Then at the very end, I go through and I have a list of all the positive things, and it's still quite long. My definition of positive as it applies to this video is when the 50-day simple moving average is above the 200-day, and I might run out of room on the bottom. I usually bump this whole column up, and I didn't do that this time. And it's small enough as it is. When we look at growth and value all by themselves, they are in uptrends. Copper's in an uptrend, even though it's really been pulling back. The British pound to the US dollar, gold, silver, US dollar index all by itself, the CRB index, the big software companies, the mega caps, the FANG index, the low volatility by itself, but when you compare it to the S&P, back to really underperforming. Staples are in an uptrend, the Dow Jones Composite Average. We look at total bonds based on price. Those are going up, except there's one. We have the World Bond Index. It hasn't crossed over positive yet, even though it's been really improving. The tech sector, as well as semiconductors, the high leverage loans, I watch that pretty closely. The Dow, the NYSE Composite, and Wilshire, those are two broad market indexes. The NASDAQ and NASDAQ 100, the mid caps, small caps, and micro caps are still in uptrends. All stocks, emerging markets, and I did have just barely enough room for, actually, Bitcoin is now dropping below. This should actually be added to the negative slide. And then the negative version here is when the 50-day moving average is below the 200, where we still have the euro, and I still haven't changed this for the third week now. This should be the US dollar here, and the Japanese yen to the US dollar. ARK is in a downtrend, and the Pring World Bond Index. Now, this could turn over positive. We see a little bit more upward move with the euro. It could turn positive against the US dollar. But we're still looking at some weakness with ARK and the Japanese yen to the US dollar. Thank you. I really hope you found this helpful. I hope you have a great weekend, and I will talk to you in the next video.